Hey folks, welcome back to the channel. And there's a lot of economic data coming out for this upcoming week. So on Monday, there's not a lot of news. It's kind of the calm before the storm. But on Tuesday, we get new CPI numbers for the month of August. On Wednesday, we have the Producers Price Index, which tells us if the price is going up or down for manufacturers' input costs. And then on Thursday, we have a whole lot of information, different surveys and retail sales. And finally, on Friday, we get an idea of how confident US consumers are feeling about the economy. So on MarketWatch.com, they have a neat little calendar that tells you which economic reports are going to be released on which day, and it also tells you what time. And this is all in Eastern time. So if you're on the West Coast like myself, you just add 3 hours to that. Now, economists are expecting CPI to go down, especially core CPI. According to current estimates, headline CPI is expected to fall just 0.1%. And that's mainly due to energy prices falling. At the same time, core inflation, which takes out energy and food, is expected to go up 0.2%. Now, compare these estimates for August with the previous month. So, headline CPI for August is expected to be minus 0.1, whereas the previous month it was 0. So, that is good that it's falling. Core CPI is only 0.2%, whereas before it was 0.3%. So we want to see these numbers fall because that's how the Federal Reserve will back off on raising interest rates. And the more quickly interest rates stop going up, the better it is for the stock market. Here's the annual inflation rate over the last year or so, and we can see that from March to April, CPI went down. So the stock market really liked that, and it rallied because everyone thought 8.5 was the highest at that point. We've basically hit a peak inflation rate, and from then on, it would just continue to go lower. However, obviously that did not happen because the next month in May, we got an even higher CPI read compared to March. And the month after that, we got 9.1 before dropping back down to 8.5. So if we want the stock market to go up, we have to see an August CPI reading that is below expectations. So let's say economists are expecting an 8.0 and we get like a 7.8, well, then stock markets are probably going to rally. However, if we get something like an 8.4, then that means inflation is still pretty sticky and we'll probably see a sell off in the stock markets, as it means more Fed tightening is probably going to be the case going forward. So the CPI data is basically the biggest one to watch out for. PPI is also good to keep an eye on because producer prices now are going to affect consumer prices later on down the line. Now, something else to be mindful of is unemployment claims because this correlates with recession, and that comes out on Thursday. On the Fed's website, if we take a look at the continued claims for unemployment, you can see how almost every time the number of claims go up, it tends to correspond with this gray bar, which means recession. So right now, if I look at the 1-year chart, the number has been heading down up until about summer of this year, and it's important to keep an eye on this slope because if this gets steeper, then there's a good chance that we're going to see one of those gray bars here in the future. So what does all that mean for the stock market? Well, we can take a look at the S&P 500, the index, to get an idea of where markets might be going in the next couple of weeks. And it closed on Friday at 4067. In the very short term, it looks like the index has been going up, but I don't think this trend is going to continue. Usually 3 bars going in any direction would show short-term exhaustion in that direction. So we had like 3 green bars going up, but then it just flatlined after that and went down. 3 bars over here, and then it went pretty much flat. 3 bars over here and flat. So even if the market were to continue going up, I would expect it to at least flatline for a while before going back up. But let's take a look at some technicals here and see maybe in the short term where the stock might be going. At least over the last few weeks, we can see that the index has been sort of making this downward trend. And right now we've broken out of that trend. So whenever this happens, the most likely scenario is it's going to drop back down and at least test the top of this trend. And that's going to be around the 3,900 mark. So I'm going to put a circle right here. That's kind of where I would expect the market to go in the short term. And there are multiple reasons why the index would go down to the 3,900 level from today's price of 4067. One reason is because usually the price wants to retest the top of that downward channel to confirm whether it's going to get a bounce from there or it's going to go straight into it and continue going down. Another reason is if we look at a longer trend from the June lows here, and we connect that with the bottom of this one over here, with the bottom of the current one that we've had, you can see it pretty much lines up with where I drew that circle. So even if we're on a medium-term upward trend, we would still have to come back and test the bottom of this support line. If we get rid of these trend lines here and just take a look at a longer trend of what the S&P is doing, we can see that there are basically three bands here. One is going this way, kind of the lower band. And if I copy this and just move this higher, we can see that there has been another range over here. I'll make that orange, and then I'll copy that again, and then another one up here, which I'll make more yellow. So basically what's been happening over the last, it looks like, year or so is the S&P has been range bound in this top channel first. It zigzagged up and down up here until about May over here at the end of April. That's when we got the really bad news with the CPI. That March, the 8.5 wasn't the highest point. So that really spooked out the market, and we just continue lower from there. And we basically entered this new trading range, which is this orange channel over here, and we bounced up and down from there. And then things got really bad in June, and we broke through that orange channel, and we started to use a new lower range. And it looks like we've hit a low point here in June before starting to go back up. And now I would say we're basically back in this orange channel. The market tried to go above this and go back into this yellow channel, but you can see there was some strong selling pressure right there, and we were pushed back into this orange channel. So if I turn on the 21-day exponential moving average, which is this blue line right here, you can see we're very close to it. So on Monday next week, I don't think the market's going to move too much because everybody's going to be waiting for the CPI report on Tuesday. But I think even if we get good news on Tuesday, there's a really strong resistance between these two channels, like right there. So either we're going to hit this blue line, the EMA, and continue down, or we might go up all the way to this purple line. It's the edge between these two channels, and I think we're going to head back down from there until eventually testing that 3,900 point level. So that is, I think, what's most likely going to happen. But of course, the stock market is unpredictable. So what I'm going to do this week is wait until at least Tuesday after the CPI reports come out to make any new investments in my portfolio or do any stock trades. At the same time, though, for options, I think it's a really good opportunity because I do think this week we're going to have higher than normal volatility. So I'm going to be using some option selling strategies like bear call spreads, for example, to take advantage of that higher volatility and also taking advantage of time decay. So I'm going to take some notes as I do them, and I'll give you guys an update next week. Thanks for tuning in. Good luck with your investments, and until next time.